Hi, my name is Nikki Ehrenholtz, and welcome to JD Krebs Financial Group, our first and hopefully only virtual client event. I'm going to bring the guys in here, and we are going to have a great time together. So welcome, Todd. Welcome, Scott. And if we could just get a hold of John here, we're going to be able to get started.
Sorry, Nikki.
John.
Sorry about that.
John, okay.
Sorry.
John is here, and
Hey,
we're
everybody.
ready to go.
Hi. Sorry about that. Yeah, it's on the phone.
Hey, nice shorts, John.
Thanks, Todd. I appreciate that.
Those look nice.
You like that
At
yellow?
least he's wearing something besides underwear down there.
Appreciate that. Appreciate that. Well, welcome everybody.
The
to
weatherman.
the weatherman. What are you talking about? What weatherman?
You look good on top and shorts on the bottom.
We're kind of like a weatherman because we try to predict things and we don't get them right, but we don't talk about it after the fact, right?
That's
Shucks.
a good point.
Well, welcome everybody to our first virtual client event, as Nikki said. I'm going to share my screen with you all so you can see the presentation we want to talk about today. I want to give you a little disclosure first and foremost that we're using technology as our friend today. We've been making a lot of phone calls. Todd and Scott and I would say we've probably been calling 50 to 75 clients, each of us, a week the last 8 weeks, 9 weeks. We would have had a client event tonight. Today is May 11th, the day we're recording this. We would have had an event tonight. We wish you were there. We wanted to be buying you dinner, shaking hands, seeing 150 of you in person, but that's not the way it worked today in the COVID times. So this is our new normal for now. We want to hear from you as we get going, but also this information we think is very pertinent right now regarding what's going on. So my disclosure is I have a screen in front of me that has the camera and Zoom and the PowerPoint presentation to my right, some notes up on the screen. So I want to be making eye contact with you, but today it may not be as easy as that. So again, we want your feedback. So we'll ask for that again at the end. Just want to know that we're using technology well to be efficient with our time and provide you timely information. So let's get right into what we're here to talk about. The last 3 months have been crazy to say the least. We had an all-time high in the stock market in February of this year. 2019 was even a better year. The U.S. stock market is measured by the 500 largest companies in the U.S., made about 30% last year. And we were up another 5 to 7% on the year come mid-February. And then stock markets change rather quickly. You can see right about the 19th of February was the all-time high of the market. We proceeded to drop 37% between then and March 21st, and then rallied back to end the quarter so that for the quarter, the stock market fell 20%. Very abrupt, the fastest decline we've had, I believe, in the last 100 years. So after that long 11-year bull market that we had, we're now in a bear market, a decline of 20% or more. So there's three major categories of bear markets. The first is structural. Second is cyclical. And the third is event-driven. This is an event-driven bear market. But while it is event-driven for now, it could easily turn into a cyclical bear market when you consider we just had the longest economic expansion in the last 90 years. And this event-driven recession could create a domino effect, causing a cyclical recession. Now, we don't know that for a fact. I wish we had a crystal ball. Our joke lately has been, we've tried to buy them from Amazon, but they're sold out. So we don't know what the future is, but we do know some facts. One of them is interest rates have gone down. This will create less desire for bonds in the short term and might push some more money into stocks. That's part of what's happened in the last 30 days as the market has rallied off of those lows of late March due to the CARES Act becoming law. So in addition to interest rates declining, the government and the U.S. Treasury Department and Federal Reserve announced a $2.3 trillion stimulus package at the end of March, with future stimulus packages already being discussed and proposed. Because of all the volatility, both expecting that stimulus and leading up to it with the pandemic, we just experienced in the month of March the 6 largest one-day point gains and losses in Dow Jones investment history. We've had percentage gains that are greater or less than this, but as far as point gains, we have had the biggest, again, number of gains and losses. So,
hey, John, there's some stuff over with you.
I'm on a call right here.
Oh,
so
man, sorry,
I'll
man.
have to do it later. Thanks,
All right,
thanks,
thanks.
Scott. All right, sorry about that. Crazy times around here. Scott Lundy just doing his job. That's good. So it's very hard for us, really impossible to predict or understand how this economy will recover going forward. We do know this, since the economic activity drives the earnings and profits of corporate America. In other words, the stocks you own, the direction of the economy will influence the stock market going forward. So if you think about economic activity, you're buying stuff at Walmart or at the Apple Store or your Verizon monthly bill or traveling or staying at a hotel. This is all economic activity. We know that that's going to be down with COVID-19, new restrictions in place, probably even the fear that people have as a result of this for many months to come. It's acceptable and I think right to believe the economic footprint will be smaller. And if there's less money being spent, stocks in essence earn less money, companies make less money, and so that's why we're a little concerned at this time. So what's an investor to do? Because of what we've talked about, we've chosen to be more defensive, reducing exposure to stocks for most of our clients. That started actually in the second half of 2018, continued on throughout 2019 and into this year. Most of our clients reduced their risk in some way, shape, or form in the last 18 months. And some, we've done this a little bit more even in the last 2 months. Is this the right decision? Only time will tell. But that's part of the reason we're trying to be as communicative as possible to you, to integrate not only our beliefs, but also the indicators that are non-emotional and disciplined so that we can apply it to your investments and your financial plans along with your appetite for risk. So I just mentioned economic indicators. What are those? You know, if you've been a client for a while, we've been using these with you in person the last few years. We've been using them internally about 6 years because I didn't want to come out of the last recession they came out of in 2008 and 9 and not have some guide marks, if you will, to give us direction in the future. So this is what the indicators looked like 13 months ago, April of last year. Nothing special about the date other than when I started planning for this, it was a year before. So notice there's 16 green lights, green indicators, 2 yellow and 2 red. If we fast forward to this past February, we had 10 green lights, 8 yellow and 2 red. Not nearly as healthy as a year ago when there's all these green lights and just a couple yellow and red, but still definitely growth potential, economic activity still increasing. In a matter of 1 month, from February to March, you can see we went from 10 green lights to 5 and from 2 red to 12. And if we take that 1 month farther into April, we went to the 13th red light. Actually, the equity market valuation declined, or the indicator turned red because stocks rallied, even though it doesn't seem warranted right now. So that's one of our set of indicators, Rockdale. This is what they looked like in 2008. So the last recession we had 9 red lights leading on the front end of the recession. So by March of 2009, when the market was at its bottom, we had 14 red lights. And in July, 4 months later, we were seeing sizable improvement. That's how we intend to use these going forward too. Right now, we see them getting worse. You can see, as I mentioned, March to April. If we start to see them start to improve, we would then. Hey, John, have you heard from? I'm in the middle of a call here. We get a client call right now. Can I get back to you later on that? But those are nice shorts. They look good, buddy. Thanks, you too. Yeah, thank you. I appreciate that.
Did he decide to wear shorts too?
Well, you know, it's just a cool thing to do, Todd and Scott. If you guys don't know, I mean, it's summer, so the last set of indicators I have here is Alphalytics. Sorry about the interruption, but we're having some fun here today. Yeah. So Alphalytics is the second indicator, company indicator we use, and if you look at the score here, the 3-month average is 71 and the 1 month score is is 39. Notice that this data goes back to 1968. And back to 1968, every time the score has fallen from a high number down to 70, it is signaled a recession is going to start. Again, we don't know how long this will last. We really don't. But we use these indicators on a monthly basis to guide us. Right now, they're showing recession risk, sizable recession risk. So to put that in perspective a little bit, it's hard to know how have we done versus the market or other investors. So how has the legend Warren Buffett done? And it turns out that Warren's investments that his firm, Berkshire Hathaway, manages, those stocks declined from the peak of the market in mid-February, 37% to the low on March 24th, the same as what the stock market. But what I want to focus on is Warren's quote here. The stock market is a device for transferring money from the impatient to the patient. The interesting thing is, a week ago, Monday on the 4th, I was reading the Wall Street Journal, and the Wall Street Journal had some commentary from Warren Buffett's, Berkshire Hathaway's annual meeting from the prior weekend. And the question was asked of Warren, and I think the question that was asked, Warren, why haven't you bought anything in the last 6 weeks? Because they somehow knew that he hadn't bought any stocks, even though the market had been 20% lower. So stocks have been 20% lower a month earlier than when the question was being asked of Warren. This is the most legendary stock picker ever. His response was, we have not seen anything attractive yet. So I think that's interesting that the Oracle of Omaha has not seen anything attractive yet. We haven't either. So right now we're prepared but not scared. And what I mean by that is we have a lot of money in safe places for our clients. If this economic recession lasts longer, there's going to be some phenomenal opportunities. So we're going to continue to watch our economic indicators. We'll continue to watch the economic data on a daily and weekly basis that we look at. And when we feel it's a prudent time to increase risk and exposure to stocks, we will. But in the meantime, to Warren's line, we're being patient. I believe the reopening of America and therefore the improvement in the economic data and the economy as a whole will take time. And because we're not out of the woods yet, we are being patient at this time. So we may have to be patient longer than we would like, but it's what we're doing at this time. So that's kind of our take on the economy and the market. Just a couple ideas we can implement for this year. Number one, the new CARES Act that I briefly talked about that was passed in late March, suspended mandatory IRA distributions this year if you don't want to take it. So if you're age 70 and a half or now 72 and older, and you need to take an IRA distribution, that has been suspended this year. You do not have to. And we'll talk about that with you as we move forward. Volatility can be scary. It's no fun going through times like this. We get it. We know it's scary. So what can you expect from us? Regular communication. We'll continue to communicate with you on a regular basis. We will provide more frequent discussions. Again, we've been on the phone almost constantly the last 2 months. That's why we want your feedback. If you like this, and review of economic, income tax, estate issues on top of the investments, of course. So we appreciate you allowing us to work for you. We really do. We love working for you. I know Todd and Scott do as well. I speak on their behalf. We do have a client event still planned for August 24th. The goal of a client event is that if you bring someone to a client event, which you can't today, but if you share this with someone and someone wants to come in and meet with us for the first time, we ask them what brings them in to see us. And in that case, we would recognize you by bringing you to a fun event, a comedian we have for the 24th. Hopefully it's not virtual. It is planned at O'Neill's at this time. We'll keep you in a loop if you qualify. So we'd love to have you introduce us to someone if you believe it's in their best interest and we can help them out. So on that note, I want to say thank you for allowing us to visit with you today. Todd, I want to see if you want to say anything to everyone before I let them go.
Hey, thanks for joining us, everybody. Look forward to seeing you soon, and be safe and healthy.
Yeah, thanks for watching. We miss you guys. Can't wait to see you guys in person again. And like Todd said, be safe.
All right. Well, on that note, you can see Todd at his shorts on when he left, giving me a hard time. And I see Scott froze somehow. We had an unstable internet connection, so you didn't get to see his green shorts, but we all tried to play the part today and have some fun with you. So again, we value your feedback. Would love to hear if you watched all of it, part of it, what you think of it. We want to serve you well. So thank you again for allowing us to serve you.